Is the Canadian real estate market being driven by supply and demand, or is it being driven by these bidding wars where buyers are going crazy? Well, in this video, we're going to discuss what BMO, one of Canada's biggest banks, says about it. And make sure you stay until the end because we're going to discuss specifically whether or not it still makes sense to buy property in Toronto and the GTA. So, let's get to it. Hi everybody, my name is Connie Sarvananthan and I'm a real estate agent and investor here in Toronto and the GTA. I grew up in Toronto, so I know this city like the back of my hand. So if you have any real estate questions or you're thinking about buying or selling real estate, feel free to call, text, email, or WhatsApp, and we'll be sure to take care of you. So what is driving this real estate market? Well, in this video, we're going to cover a Better Dwelling report that talks about this specifically. And Better Dwelling is quoting BMO, which is the Bank of Montreal. And BMO is looking at the numbers and they're comparing it to our last crazy market in the 80s when it crashed and seeing what is similar and what's not similar. So let's get right to the report and go through it. Okay, so what they are saying is Canadian real estate prices show record growth. Now, we all know this. Canadian real estate prices are rising, and they're saying they're rising even with more supply coming to the market and higher interest rates on the horizon. Annual growth, according to the CREA benchmark, and CREA stands for the Canadian Real Estate Association, reached 28% in January 2022, which is a record for that index. Now, the index doesn't go back to the 80s when we had the last bubble, but it is a record for the time that the index has been around. And the other big thing is in the last 2 years, prices have gone up 46.4%. So another record-breaking number, but most of the growth hasn't occurred in emerging global hubs, but rather small cities in the country. So that's where BMO is having its challenges. It's not just the big cities that are growing like this. It's also much smaller cities that are growing like this. So let's look at the numbers in a little bit more detail. Okay, so this is where BMO compares what's happening right now to what happened in the late 80s. And I find some of this stuff really interesting. So Canada's late 80s real estate bubble was smaller. So the CREA housing price index only goes back to 2000. So some people kind of question whether or not it makes a good comparison. But basically what BMO said is that because they didn't have the information to go all the way back, what they used instead was average transaction price from the land registries. So land registries is where they record the changing of ownership of a property. So if I had a property and I sold it to Jane Smith, then land registries would record that sale. So they would record my name, her name, how much we sold it for, and it's all done through the lawyers. So that's where land registries is coming from. And so what BMO says is even though the housing price index only goes back to 2000, they use the land registries. And what they found is that that the records were still breaking regardless. So what's happening right now is record breaking. And this is a quote exactly from BMO. In other words, the Canadian housing market has just seen bigger increases than ever witnessed through any 2 years of the great housing bubble of the late 1980s. Just a reminder that that episode ultimately saw the overnight rate to 14% to quell inflation and bring the market to heel. Prices then went into the wilderness for a decade. So what does all of this mean? So the overnight rate is the Bank of Canada rate, and I did do a video on this that I'll link to, talking about the overnight rate. So right now our overnight rate is 0.25, and they are expecting that to climb. But just to give you some perspective, we're at 0.25, and in the late 80s it went all the way up to 14%. And so what they're saying is what happened in the 80s is that They rose the overnight rate to that to quell inflation, and so the market did crash, and then prices went into the wilderness for a decade, meaning that there was no movement on prices for 10 years after the crash. Those unfamiliar with interest rates may think a 14% climb will to be impossible. However, the impact of interest rates is dependent on the sensitivity of the debt. A highly indebted population can see a similar impact with smaller rate increases in rates. So what they are saying here is, you may think, oh, we'll never get to a 14% overnight rate. And they're saying, yes, that's true. But the overnight rate and the sensitivity to it really depends on household debt. So it doesn't necessarily have to go all the way to 14 to make a big impact. The number might be 7%, it might be 6%. But, right now we're at historic lows. And as we go up, that is really going to hit people. And, if you bought a house and you're paying 3 or 4% interest on that, if that were to double to 8%, would that affect the market? So that's what they're saying. We don't actually have to go up to 14. It could be something else, depending on the household debt levels of Canadians, which is quite high right now. And then the final thing is, if you think it's different this time due to population growth, one should consider the pace in the 80s. At the height of the late 80s, the real estate bubble, population growth outpaced today's recent cycle peak. In 1989, the population growth rate was more than a quarter larger than that of 2018-2019 peak. It turns out immigrants stop moving to a place when the value proposition collapses. Shocker, I know. So what they're saying here is, one of the reasons why we have a supply issue is that immigration is high and our housing stocks are low. So if we continue with strong immigration policies, which we're doing, then and we're not building enough homes, then there's going to be a supply and demand issue, and the prices will continue to go up. But what this is saying is that the immigration was also high in the 80s. However, if we continue to have crazy housing prices, immigrants may not want to actually come here, because if the cost of living is so high, they may not want to consider moving here. So that's what they're saying here, that immigrants stop moving to a place where the value proposition collapse. So that's also what BMO is saying. So let's see what they say next. Okay, so this is their conclusion: is the Canadian real estate driven by madness or supply? When you look at Toronto, the Greater Toronto Area has a gross domestic product, so the GDP of the Greater Toronto Area is bigger than most Canadian provinces. So steep price growth, arguably in Toronto, could be justified if you believe that Toronto is the next Manhattan. So what they're saying here is, first of all, I used to work for HBO, and so the head office for HBO is in New York City, in Manhattan, and I worked there for 12 years. And when my colleagues in the HBO office, I would say half at least, commuted into the city, sometimes 2 hours each way. And that was not unusual. There was a lot of people that did that. So what they're saying is, if you are convinced that Toronto is going to become like Manhattan, where it's so super expensive and people are just going to be doing these long commutes to get into Manhattan because Manhattan and its surrounding areas are so expensive, if you believe that's what's going to happen with Toronto and the GTA, then the prices might be justified. And they're also saying that the government believes that the prices are overvalued across the board. The Canadian government has said, mentioned many markets that they're saying can be up to 50% overvalued. And what the Canadian government's issue with this is that they are concerned about household debt as families overstretch to buy this, and then they're vulnerable to any sort of minor changes. So interest rate changes or changes in their employment or whatever the case may be can really affect it. So in a nutshell, what they're saying is, maybe Toronto can justify it, maybe if you think it's the next Manhattan. However, what they're saying is most of the growth has occurred out in small cities. It's not these international hubs, but relatively unknown places to the global investor. So what they're saying is a lot of this growth is coming from these small towns that a global investor wouldn't even know. And this is the quote: "Some of the wildest markets in the country remain smaller and medium-sized cities in Ontario. Not to pick on Brantford, but that fine city, previously known mostly as the home of Wayne Gretzky, has seen prices rocket 86% in 2 short years," highlights the bank. So that was a quote from the bank. And if you go back to this chart up here, the blue is the Canadian home price average, and the red is Brantford. So this is where you're seeing the red way up here for Brantford versus the average across Canada. So that's what they're saying, and that's what they're worried about. They're also saying a similar trend can be seen across Ontario's cottage country, where prices rose the fastest. BMO cites Barrie, Welland, Tillsonburg, Woodstock, Chatham, and Guelph as further examples. They're all charming places that might be future global hubs at some point. However, they're closing the gap between Toronto so fast, they might be killing growth prematurely. And so what they're saying here is those cities might actually become global hubs at some point. But when your prices rise that much, you start to lose some of the incentive for moving to those cities, whether you be a company or whether you be an individual. So if you look at somewhere like Waterloo, where a lot of the tech companies went to because that's where a lot of the talent was, Waterloo was still affordable at the time that those tech companies went in. I'm not sure if you start to get really crazy housing prices that, you're going to see the same amount of growth, and that's what they're saying here. And then the final point from the bank is, they asked rhetorically, do you seriously believe that each and every one of these smaller centers suddenly suffers from a supply shortage? Or could it possibly be that a common demand factor is driving the madness across the entire region? So BMO definitely thinks, especially in some of these smaller towns, that it's not a supply issue, that it's actually rather a buyer issue, and the buyers are just going nuts. So that's kind of it for the report. And if you ask me what I think, well, a couple of things. First of all, if you look at the other reports that are linked in here, this one says the Canadian property bubble reaches the contagion stage and mortgage rates forecast to rise 40%. That's from June 20th, 2021. And then this one, a bank warns Canadian housing price may peak soon, and that the buildings always lead to higher prices. That's from May 2021. So my thought is, you can't predict the real estate market. Nobody has been able to do that well because there's so many unpredictable things that happen. So COVID is a perfect example of something that nobody could have predicted and therefore could not have known how it was going to affect the housing market. That said, I think if you are going to buy in this market, I think there's a couple of things you need to consider. First of all, it's all about what you can afford and what you can maintain. If you're going to buy a house and you're planning on staying in it for a long time and you can handle any changes in interest rates, plus minus to a reasonable amount, then you should be good. If you are stretching yourself to the absolute limit and any small change in interest rates is going to affect you, then I would reconsider your budget and make sure that you are going to be in a position where you are okay if there's changes. I know families that purchased in the late 80s right at the height of the boom. And then, it crashed. Now, they kept those houses and they lived in them for, the next 20 years. And then eventually the prices came back up. So on paper, they lost a lot of money. They lost almost half. But then eventually it came back up, but it didn't really affect them because they were able to maintain everything because of they weren't selling. But if they had to sell, then they would have lost money. And that's where you just need to consider that if that happens. And then the last point that I would make is that if you're an investor and you're hoping to make a quick flip, then you need to reconsider that too, because it's not necessarily going to happen. It could happen. I mean, look, people who bought 6 months ago may have, a lot of people made $200,000 in 6 months, but you can also lose $200,000 in 6 months. So be smart about it. Make sure what you are getting into, you can afford the gains and the losses. But Toronto real estate and Toronto and the GTA real estate continues to be strong. I'm not sure if the prices will continue to rise the way that they have been, but I also am not sure that they're going to crash. But like I said, nobody has a crystal ball. We never expected COVID, and something else could come in that can make the real estate market drop, or something else that could come in that could make the real estate market keep going. So that's it. If you have any questions, let me know. So that's it. I hope you found this helpful. If you have any comments, good or bad, please put them in the comments below or reach out to us. If you have any real estate needs or questions, feel free to call, text, email, or WhatsApp, and we'll be sure to take care of you. Thank you for listening, and I'll see you next time.